Okay, good evening, guys. Welcome to another one of my live webinars. As we're still in the early days, as I've said, I've presented well over 1,500 webinars in the UK and Europe over the years. Still fairly new to this side of the world, so just getting the word out, letting people join the webinar at their own pace. We're going to go through another pretty broad educational topic. The first part of the webinar, we're going to go to one of my absolute favorite technical tools, Fibonacci, something I've used in trading my funds, really my day-to-day interpretation of the markets, my algorithms, my book, and lots of other kind of webinars feature, elements, some elements of Fibonacci. So we're going to go through that, and then we'll have a look at the markets, see what's moving the markets today. We've got Mark Carney from the Bank of England he'll be speaking about 15 minutes. So we've already seen a bit of a move in the pound. So we'll go through some ideas of how that can move the pound against the various currencies. If you're interested in trading the FX markets, then we'll look at the indices, so the major stocks around the world. Seen a bit of a move down with the strength in the euro. So explain those correlations for you. Other things, individual stocks, maybe commodities. As I say, we're just kind of finding our feet here, a bit of a sounding board for, who wants to know what, and people's different interests. Again, there's no questions that you can ask me that are wrong. Any questions you ask can certainly help other people, and there's nothing that I can't give you my opinion on. Having done so many webinars and met so many traders, there's pretty much nothing that you can ask me that I can't give you an answer to. Might be the answer you want, but I'm going to give you an answer to it nonetheless. Okay, so just waiting for the clock to tick on the hour. It's just done that now, so we're going to begin the presentation. So Fibonacci, there's a reason why it's still used. So the basics around Fibonacci are the numerical sequence. So 1, 1, 2 equals 3, 3 and 5 equals 8, 8 and 30 equals 21, etc., etc., etc. So I mean, the actual numbers themselves just lend themselves to the mathematics, and the idea behind Fibonacci. We don't use the Fibonacci numbers in Fibonacci itself. Fibonacci is much more about the movement, and a lot of people fall down using Fibonacci because they don't actually pick the right plotting points to put Fibonacci from the low point to the high point, or the high point to the low point, and that's the absolute crux of having a successful and a system that you can kind of repeat. Now, there's no secret to trading that being a successful trader, one of the most common traits is consistency. If you can be a consistent trader, limit your downside, and scan the markets, correctly interpret them, you're going to make some good money. A lot of people forget that you can lose every other trade in trading, but if you have the right risk reward ratio, you can still be a profitable trader. So for me, when I look at the markets, I'm looking to do a trade. Fibonacci is one of the things that I'll draw on the charts first of all. That might be from a higher time frame perspective, looking at a monthly chart, a weekly chart, or a daily chart, trying to find those pivot points, trying to find those points of attraction. Or maybe I just use it on the hourly chart, where the majority of my trade ideas come from a technical perspective. So again, we're not really kind of looking at the maths behind it. We're looking for that much more visual way of using the Fibonacci retracements and expansions. There's lots of other different Fibonacci's you can use, like Fibonacci timeframes and zones and Fibonacci fans, things that I've never really used too much in my charting or my trading, but certainly the Fibonacci retracement is an absolute staple. And once you kind of go through this presentation, you'll have a good idea how you can use it yourself and how you can get better trade ideas from that. So the two main ways of tackling the markets and looking at Fibonacci is to do with movement. So you're looking for a strong directional move. Okay, there's something that's formed a trend over a period of time, or a breakout candle, or a quick move. Okay, so that's generally after some data or some new news into the markets. Now we can look at the retracement, which will be the key level of the 50% and the other major Fibonacci's that you'll see, and the expansion points, which people don't use too often. So that's again when you're trying to predict new highs. So the FTSE, for instance, if you're trying to figure out where the FTSE can go, what I'll do when we open up the live markets, I'll do a Fibonacci expansion, and I'll be able to show you, where the potential highs in the FTSE could be. So that's a great way of predicting the future, where you have no previous levels to go from. So when the market's been making all-time highs, like the indices have, then the Fibonacci expansion to one of the only really kind of good ways to figure out where markets can find new levels of support or resistance. So remember, the whole point about the Fibonacci movement. It is that finding a start point, finding an end point, and then using the Fibonacci framework to work with, to give yourself the confidence to do that time and time again over the different time frames in the different products, and to make some money. So example. So there's a reason people fail with the fibs. So that's probably one thing we should start to look at. And like other studies, like the Elliott wave, you have to decide, where you plot the Fibonacci to and from. So this does cause traders, problems, because a lot of other indicators, maybe like Bollinger Bands or your moving averages or oscillators like your RSI, you have points. You have absolute points of what to look at. The lines are drawn for you, and the values are given to you. Whereas the Fibonacci, you have to decide, where you're drawing it from. So really, the first thing that comes into play with a lot of technical analysis is you've got to go back to the self-fulfilling nature of technical analysis, which means, if it looks right, it's going to look right to others. One of the biggest problems traders have is they try and learn too much. They try and put too many things onto their charts, and they get confused, they get muddled. You've got to keep the chart simple. If it looks right to you, it's probably going to look right to other people, and that's the self-fulfilling nature. That's why moving averages work so well, because they are very clear and easy to interpret for support and resistance and market direction. So the consistency you're using breeds confidence. If you can go into any chart on any time frame and draw yourself an accurate fib, you're going to have a lot more confidence in being able to make money from that. So that means your whole trading strategy is going to get better. Then once you've drawn your fibs, you've got to commit to them. So I'll show you what I kind of draw my fibs and how I look at them. And my 80% rule is that at a strong directional move, 80% of the time will retrace to 50%. Now that's 15 years of charting, 15 years of trading, and I'm absolutely committed to that figure. Yeah, it might be honesty might be 79%, 81%. I don't know, but over my trading career and over the amounts of money that I've made and lost, and decisions I've made, I can say, really on average that around about 80% of the time, if I've made money in a trade, it's come from a Fibonacci retracement, sticking to the rules that I know have worked. Obviously, nothing's 100%. And if you try to find something that's 100%, then trading's not for you. You have to work in percentages, and you have to know that taking a loss is part of trading. It's as simple as that. If you can't deal with losing money, you're never going to be able to make money. So again, when you're looking at the final part of the Fibonacci, you've got to take a good sample of data, on extreme moves. So for me, again, I'll show you these strong directional moves, which you see time and time again in the markets, or something that's just out of the ordinary. And you can see these candles, these big green or red candles, a mile off. And that's generally to do with movement. It's generally to do with something new happening in the markets, or the market anticipating something that's big is going to happen. So again, once you've got all these 5 things in mind, and you look at the markets, you're going to be able to trade with a lot more accuracy, or certainly chart with a lot more accuracy. And that, that is half the battle. So what we're looking at here is the money's made on the left-hand side of the chart. So this is what we know. We know the markets, this is moving up. We can see, a simple indication of trend direction and line rejections towards the low of the candles, the market moving higher. But what we see at this point, is the market has made a high. Okay, and it's made a low. So from this point onwards, these are our extremes. The 100% at the top, the 0 at the bottom. Now I've said to you, that 80% of the time, a strong directional move, if we don't make a new high or a low, once we've found that, it will retrace to the 50%, 80% of the time. So that's what we're trying to figure out from here. So this is an hourly chart. Now again, I've just picked a random currency, Aussie versus the Swiss. So what we're finding is the market hasn't made a new low. Okay, even though it's broken this uptrend, but what we're looking for is this 23.6 going to be a support point. So in the short term, we might be able to buy it and look for the next decision point, the 38.2. The 38.2 holds, you've got a greater chance. Just think of like the Elliott wave movement. As we find strength, as the market moves up, people buy into the Elliott wave. It's very much the same as the Fibonacci. If it doesn't make a new low, and the trend was up, then it has to make a new high. If it's going to make a new high, it has to go through the 50%. So you're looking for the trade from here to here, here to here. Now, it might not be the biggest trade you've ever made, and it might not make you rich. What I'm trying to teach you as an intraday trader, as a short-term trader, is it isn't necessarily about being right. It's about being right at the right time. You're trying to make money from intraday movements. You can buy the market here, sell it here, or you can buy it aggressively average and buy it to the 50%. There's more than one way to make money in trading, and it's down to you to find out what it is. But if you've got above the 23.6, you've got 1, 2, maybe even a short scalp here, 3 opportunities, to see the market get back to that 50%. And if it doesn't, and the market's going to continue down and it rejects the 50%, it's going to make a new low. So your next trade could be a sell of the 23.6. If it makes no attempt to get back to the 50%, which happens 80% of the time. Remember, if you're in that 20% bracket and it breaks the 23.6, you've got that 20% chance that it goes on to make a new low. So it's either going to attempt to get back to the 50% or make a new low. So it makes your trade a lot easier to do. If it starts to creep up, you're buying towards that 38.2, you're buying towards that 50%, or you can even buy and hold. Or if it doesn't get anywhere near it and rejects it, the downward trend is going to continue. So you sell a break of the 23.6. You don't necessarily have to make a new low, but then you can make 10, 15, 20 pips on the way down. If you're trading the right kind of size, then, 10, 15, 20 pips is important. I only look for 10, 15, 20 pips of a move. Sometimes I'll scale out and leave some on the table, but I trade in hundreds of pounds of points, thousands of pounds of points at time into average positions. So 10, 15, 20 pips for me is worth having. Okay, but a lot of people try to get too much out of trading because they don't have the right staked amount. So if you're trying to get 300-400 pips out of the market on $1, $2, you need that movement to make any kind of reasonable money. But if you make 10 pips on £100 a point, you would take $1,000. But think about the smaller stakes, how long that movement, how long you have to wait in the markets to get that. So what we're looking for is just a good way of getting a framework, a good way of getting an idea of where the market can go to in the short term and what direction it's looking at. Remember the hourly chart. You're still going to have plenty of hours before you see, a daily close. So there's plenty of open movement for the market still to go. When you go to the higher time frames, you see things closing like the dailies, the weeklies and the monthlies. They're set in stone. But in the intraday, you've got much more fluidity and much more market movement. So as I say, the left of the chart is very important as it takes into account not only the technical movement, but also the sentiment. So that really goes back to my idea of the market's going to move 80-20. So you'll hear this 80% quite a lot in trading. You should really be at an 80% win rate in your trades. Fibonacci will work 8% of the time, and the market's moving 80% of the time in a technical manner, which means people are making decisions based upon data, charts, signals, etc. Then 20% of the time, they're working off sentiment, data, news. They come together, you have to know a bit of both, and that's what makes the market move. They're moving through the technical support and resistance levels the majority of the time, and when news is injected into the market, especially if it's not as the market is expecting or as priced in, then the markets are going to move much more quickly and be more volatile. So really what we're always trying to do is balance all this information out. So we're looking for the overall trend, the current sentiment, and again, what you're trying to achieve from your trade. You've got to get it out of your head that you have to buy the low and sell the high. That's an old-fashioned way of looking at trading. All you're trying to do is generally be market neutral. Okay, so market neutral just means you can buy and sell and look for value. You don't get drawn into the trend. Doesn't mean that you can't know and respect the trend. Doesn't mean that your analysis doesn't tell you what the market should do in the longer term. But when you're trying to intraday trade or short-term trade, you're just looking to make money. Okay, so any movement above 10 pips is going to make you money in the markets. You pay back your spread, you have some profit to play with, and depending on the size, you can make money. And these trades can last for minutes, 10 minutes, maybe, a few hours. But in that short-term movement, you're going to have the option and the opportunity to bank some cash and make some money. And that is the key to trading. We're not trying to be right, we're trying to make money. This is a big distinction I've had to make with a lot of traders that I've mentored. A lot of mathematicians, a lot of quants, a lot of very smart people want to be right. They're less interested about making money. They want to be proven right. Whereas some of the people that don't have a degree in, maths, and I've actually had rocket scientists, approach me for backing and money. And, these are really smart guys. But sometimes these guys that don't have that level of mathematical intelligence that make the most money, because they're just following the rules. They're doing the analysis, they're trading the sentiment, trading the movement, and making money from each pip that the market gives them. Okay, so it's interesting. So again, fibs really work because, what we've got is when we find a way of drawing our own fibs, we understand it, we've seen it work time and time again, you're going to get upwards of an 80% success rate. So this isn't the holy grail. You haven't just suddenly listened to my webinar and it's going to make you rich. But if you can understand Fibonacci, then you're going to have a very good chance of getting a framework together that's going to allow you to trade with some consistency. And that's really the first part of my journey. As I've said to you, all these webinars I'm doing, they're live and they're free to you. I'm never going to charge you. Yeah, if you want to learn the next kind of, nitty gritty bits of how to make money from these things, then you're going to have to put some money into a new CMC account and trade it, because you won't learn the benefit of what I'm trying to teach you if you don't trade with real money. So you're just backing yourself, essentially. I'm still not going to charge you. You can still, put the money in and never trade it. But you have to show me some commitment that you're willing to kind of, put these things into practice. Otherwise, it's just pointless. A lot of people, when I first started mentoring, just trade on demo trades for, years and years and years. It doesn't teach you anything. It doesn't teach you the emotional side, which is so important. And that's why I ask, for the more important VIP webinars, that you go through some emotion with me and you learn that way. Because even if you do it $1 a point, it's still 100 times better than trading with demo money. You don't get anything from demo money. You never will. So again, the fibs, really going back to that, a particularly powerful thing to use, because unlike many other indicators that just give you an idea of direction, or maybe, that all-important confirmation, what you get with the Fibonacci is an entry point. You also get an exit point, a pivot, and future expansion levels that, just other indicators just won't give you. So a number of fib drawing practices that are extremely powerful. Many feature in my book, also my VIP webinars. So again, these are things that show you how to make money from fibs. So a strong directional trend, overextended candle, and news fibs, and then higher time frame trading. So again, points 1, 2, and 3 important. So they need their own webinar. And then, this is where you're really going to learn to make the money. So the strong directional trend, I will show you the 80% rule in action in different scenarios and what you can do with it. The overextended candle is something that happens after news or a big event, and the news fibs is all around kind of data and news hitting the markets. So again, 2 and 3 are quite similar in the direction that you'll see, but you will see they're either a technical break or a fundamental break, and they're very, very different to a strong directional move. Although they might sound the same, that they're two very, very different things. And I explain this really kind of well in the book, the Rough Guide to Trading, which I do recommend that if you want to kind of get to speed with where I'm at, you give that a read, because it does explain a lot of the things that I go through in the webinars. But some people just can learn these things better from a book and then ask me questions through the webinars, and you get that kind of tie up, and it all makes more sense. This is why I do a combination of the live stuff and stuff on YouTube, so people can just learn or get involved in what makes them feel comfortable. The kind of really end level for all these things is that you work with me one-to-one. And we do some mentoring. This is where I've got the best results. Traders that have got 20% returns plus. I have many six-figure account traders from all walks of life that I mentor, and the majority are successful. Obviously, there are a few that haven't made it, but that's the way trading goes. I can't be 100% successful, and also people don't always listen to me. That's just the way life goes, isn't it? But at the end of the day, I've certainly made a lot of people's trading journeys more profitable and more enjoyable with my mentoring than not. I can safely say that. So how do fibs work? So fibs are all about proportions, okay? So movement lends itself well to maths. So if you know where something has moved from in the past and where it can move to, we can understand then what the future movement could potentially look like. So this comes down to the well-known phrase that I keep using and will use throughout all my presentations. Trading's not about being right, it's about being right at the right time. We can all say a recession's coming, a housing market correction's coming. We can say that stocks are going to disintegrate and correct, but it's when. Okay, lots of people I know over the last 5 years have shorted the markets and lost lots of money because the markets have kept going up, because they say every time it makes a new high, well, that's gone too high, it has to come down. Well, it might come down, but if it doesn't come down until 2020, then, have you got the staying power, the account size, to ride out that movement? Well, most people don't. So we're trying to be right at the right time. Buy and sell when the market's working in our favor. When it's not, maybe staying out. Okay, so it's all about making money. It's not about patting yourself on the back saying that you were right that the stock market corrected or crashed. Well, unless you've waited for that and you put a big trade on and you've held it from the high to the low, then for the other 5 years when it's gone up, 10 years when it's gone up now, you could have just been making money buying it on the way up and selling a few little highs. So the idea of like freeing your capital up to be able to trade, for a minute, for an hour, for a day even. It's better, when you're trading longer term, you're really investing, and that money's tied up for X amount of time, and you're looking for X amount of return. Generally 3, 4, 5, 6%. As I've said, if you've got your money leveraged and you're trading in the short term, you could be looking for 5% a trade. You can be looking for up to maybe 20% a week or even a month, kind of compounded, from your trading. And it all depends what you want to get out of it. Markets will move every single day, with or without you. There will be 20 opportunities to make money in the markets every single day, and that will never change, no matter what happens. It all depends on you, what you want to get out of the trading. A lot of people approach trading in the wrong way and say, when I ask people what they want to achieve, and it's like the Bitcoin mentality, I want a Lamborghini, or I want to be rich. Well, rich is different things to different people. Some people might want to make $100 a day. Some people might want to make $1,000 a day. Some people might want to make $10,000 a day. It's all achievable. $10,000 in the market is nothing. Yeah. And kind of trader terms, if we're talking in dollars, $4 trillion US is traded every day on the FX markets. 4 trillion. Okay. So, if you're trying to make $1,000, it's nothing. $10,000, absolutely nothing. I myself, I've made hundreds of thousands of dollars in an hour, in a day, but it's all relative to your capital. It's all relative to what you're trying to achieve. So, and this is the thing, you could be right for 1,000 pips, you could be right for 10 pips. Again, it all depends on your exposure. The longer you stay in the market, the longer, the more chance you have of being wrong. Yep. So if you want to be right and get the bigger moves, you got to stay in the market for a longer amount of time. If you want to make money, yeah, you just have to be in for short amounts of time. You limit obviously your upside, but also massively limit your downside. Okay. And this is what your fibs are going to give you. So what we see here, again, is that going back to that previous chart, we see the absolute high, the absolute low. We see the market moving down to 23.6. So we have to decide if we're buying back to the 50%, which happens a strong directional move, yeah, 80% of the time, or yeah, we're going to sell the break back to a new low. So what we see here is each one of these opportunities could be where we buy. Yeah. But it's not really, it's not really working, is it? So if you're trying to buy back to that 50% and it keeps rejecting, well, the first thing you do is you stop buying it. Okay. So when you see a good hard bounce off a level, yeah, which you haven't really seen off the 61.8, you're looking for a good hard bounce like here. So this would be your indication. It doesn't make a new low. The market rejects. So you'd expect this from the future movement to go to here, find some support, and then get to the 50%. So the fact that it's really rejected, 1, 2, 3, 4, 5 times before it hasn't made a new low. Yeah. It's got to where we've measured it from, but all these points here, it hasn't made a new low. So what it's actually telling us is that that 80% rule isn't really working. Yeah. So it isn't working. It's going to continue the trend and it's going to make a new low. So it breaks that 100%. You're looking for this, that was support, to become resistance, and the market then to make a new low. And this is again where your Fibonacci expansions come from. So this will tell you the next logical point of where the market will find another point of attraction, support in this case, the 161.8. So below the 100, you get the 161.8 retrace expansion point. So again, your 50% still your pivot, but if it doesn't do what you think it should do, i.e. get back to the 50% within with not making a new low, then each time it rejects, yeah, the likelihood is it's going to continue the trend to go down. So it's an 80%, obviously getting back to the 50%, but that 20% can't be ignored. That 20% is just another indicator that the market isn't going up and isn't doing what it does normally, then it's going to do the opposite. Yeah, because if it doesn't go up, then it has to go down. So again, it's an interesting way of looking at it, and it might take you a little bit of time to get your head around it. Again, I've used this so many times that it's just second nature to me. It's just what I look at, and I'm just looking and say, right, it isn't going up, it isn't going up. Well, then sell the break, okay? And you've got an entry point, the break point of the 100, and you've got an exit point. So again, Fibonacci is doing its job for you. It's telling you it's not going up, so it isn't going up. It has to continue in the direction of which you drew the Fibonacci from, which was down. So higher time frame fibs. So this once again ties in the idea of the self-fulfilling nature of technical analysis, that the market has a memory. So this is just looking back what happened in the past, has to become into play in the future, and it has to then have greater relevance. So people not only trade, but they invest for days, weeks, and months. So big levels in the past will become big levels in the future. So again, I've used these fibs on things like gold on the monthly charts for years now to indicate where gold is going to go. So in the past, what we're looking for is monthly movements. Okay, so this 50% of this monthly move, again, we're looking at the New Zealand dollar CAD. So the market's gone up, and this time, yeah, it hasn't made a new low. It's rejected, 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 and look how quick it gets back to that 50%. So that's a monthly chart. So it's not quick in the sense that it's just happened in an hour. But you know, as you don't make a new low, you see the market rejecting, pushing lower, squeezing people out, but it hits the 61.8. It then finds support on the 61.8, and it gets back to that. Okay, so again, this strong move here, we don't make a new high, we don't make a new low. So as we don't make the new low, 80% of the time, strong direction move gets back to 50%. And it works both ways. I mean, obviously, you know, if we draw it from here to here, this is the past. So we come through the 50%. You know, that's just in the past. But if we go from the low to the high, as the market comes down, yeah, it doesn't make a new high. It's consolidating, and then look how quick it then gets to the 50%. And it aims and finds support, resistance on the 61.8, then aims to get back to the 50%. So, you know, it's just a market showing you in movement where these, you know, likely pivots are meant to be. So it's really trying to put that monthly view into say, well, actually, we've gone from the low to the high. We haven't made a new high. The market was a bit of a sideways movement, to be honest. So the direction is not giving that much confidence. But if we continue to hold below the 50% on the monthly, yeah, then maybe the short-term trade could be a break of the 61.8. Then we're going to make a new low. Yeah, but if it holds above the 50%, you start to look at the weekly, the daily, you know, how that picture's building up. But you see if it holds above the 50%, maybe it's right to make a new high because it's done what it said it was going to do. Yeah, a strong directional move that hasn't made a new high or low has got back to the 50%. So this is now the pivot. So it's either going to continue make a new high, holding above the 50%, or go and continue to make a new low. Because it has to eventually do one of these two things. But you might have to wait an awful long time for that to happen. You might have to wait 3, 4, 5, 6, 7 months. But it can't stop then filtering through to your weekly view, your daily view, and your hourly view, and your short-term trades. And that's the whole point. The monthly, it's giving you the overall sentiment because it has the most data, it has the most information. Then again, if we look at the same kind of picture on the weekly, so we're going to leave the Fibonacci monthly in yellow, so we see that 50%. Then we draw the next significant move from the weeklies, which is from here, this high to this low. So again, strong directional move on the low. So 80% of the time, strong directional move. If it doesn't make a new low, yeah, from here we'll make it back to the 50%. Well, it does. And look at that 50% on the blue ones. It is almost a perfect match. So it gets as high as the 51%. And then look how the 50% on the monthly acts on the weekly chart. All of a sudden, 2 confirmations. The market actually might be finding resistance and moving down. So your 38.2 is your next point of attraction. Then you have 2 levels close together from weekly and monthly, 61.8. So all of a sudden, you're building a framework out of nothing. You're building a framework out of the monthly and the weekly time frames. Yeah, that's higher time frames, coming down. So we come down one further, and we come to the dailies. So we do the dailies in green. So as we say, 50%, yeah, on the top, acting as resistance. 50% from the monthly, acting as resistance. Lots of rejected candles on the daily to the high side. Okay, a few on the day side to be fair, but market's consolidating. So you've got your 23.6 from the daily. If we close below it, target, 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 target. Okay, so you build up there just by using Fibonacci's from strong directional moves that haven't made high or lows. So again, you could even say, well, on the daily chart, you could sell down the 38.2. If it breaks that, it's going to get to the 50% because that ties in with the 61.8 of the monthly. Yeah, so big target where fibs tie up. Okay, and look at the consolidation when the market's been here. So a break of here, as the market hasn't made a new high or new low, you're building up fibs. The 50s are still in play. So again, it's looking for that pivot, looking for the movement, and sometimes looking for what the market's not done. If it hasn't held above the higher time frame, 50%, which it hasn't done here, well, if it hasn't held above it, it's more likely to go low. So again, that's your market neutral approach. You can buy when it looks like it's going higher. You can sell when it looks like it's going lower. But a break of the 38.2, certainly the dailies, 38.2, your 50% target, and you're backed up by your 61.8 monthly level here too. Because again, we're already below the monthly 50%, okay, and the weekly 50%. So just another way of building a framework, out of things that have already happened. These highs and lows are set in stone, okay, because these are closed. It's the hourly candles that could do anything, within reason while the markets are open. So if you look at the hourly chart, zooming down even still, then you want to set yourself, a stop or an exit, and you can buy or sell. So we're looking at the hourly chart, how that's formed. It's finding this 38.2, finding support, finding resistance, support, failing on resistance, so it's not moving higher. It's getting towards that 23.6. So you could sell here, and then you get out at 38.2. Or if you think it's going to go up, then maybe you put your stop here, and you buy here, you average in here, and you wait for the market to go back up to the overall monthly 50%. So with 36 points on the upside, 82 points on the downside potential profit, and you've got a 22-point entry point to get into your trade long or short. Now, I've just shown you how to go from monthly, daily to weekly to build these time frames. So the trade is down to you. You could easily confirm this with other oscillators, your Bollinger Bands, moving averages, or your RSI or stochastics. Again, other things we'll go through. But just by using straight line levels of higher time frame support and resistance, you've got a framework. You've suddenly got an entry, you've got a stop or an exit, you've got a stop and exit for the market neutral trade. Either buying if you think it's going up, selling if it's going down. Obviously, you can put your fundamental, kind of sentiment into that as well. But you tell me another system, another kind of indicator that gives you all these points of attraction, 80% kind of rules. And even if you're not getting the benefit of the 80, you're getting the benefit of, if the market doesn't do what it does 80% of the time, then it's almost like it's even more powerful on the opposite side, that it's going to do the opposite of the 20%. So again, 123 pip range. If you didn't know what you want to do buying and selling, as I said, we've narrowed it down to a 22-point entry, 36 potential on the upside, 82 potential on the downside. So if you're selling it, you got a 2-to-1, 2.5-1 risk with your stop. That's pretty good. So as I said, with the monthly rejection, the weekly rejection, the seller bid good, 36 pip stop to make 82. I'd take that trade all day long. So again, with the New Zealand CAD, when I did this presentation, I'm fairly sure it's gone down from there. So yeah, that would have been a good trade. But again, it's all easy and perfect hindsight. And that's why I'm picking these examples. What we're looking for is how you make money here and, what's happening in the future. I'm just trying to give you the tools right now to at least have a fighting chance. As I said, it's an 80% indicator for me. So again, I use the fibs because they give me as a trader consistency and confidence. Not that I necessarily need the confidence these days, but I need the consistency. And that's really why I do these webinars, to keep myself sharp and, to keep myself, ahead of the game. At the end of the day, I do my mentoring for different reasons. Mentoring's a very lonely, trading's a very lonely game for a lot of people. So they need somebody they can speak to like me, who's got some skin in the game. But like that for myself, I can talk to people that I mentor because generally they're pretty interesting people. I have entrepreneurs, pilots, surgeons, trust fund kids. I've got them all, in the UK and Europe. And these people become friends and people I do business with. So this is the best way I know to do my business. So I moved to New Zealand without having been here. I have no friends, no family here. Just my wife, myself, and my dog. So this is another way of getting to meet people in the webinars and get to meet people mentoring. We don't necessarily have to meet in person, but the world's an easy place to communicate. We have Skype, we have obviously phones, emails, etc. The mentoring thing can be as in depth as you want, or the other way. I mean, really, as I say, it's like a pyramid. The free information is to get people in, to get them excited, to kind of get them au fait with my trading style and my education style. And then it's the VIP stuff, which is a bit more, you've got to invest some money in yourself so you can get the emotional side of it. Then there's the mentoring where we get to what's going to make you a great trader. And then hopefully, you don't really need to speak to me apart if unless you want to. And, there's not many people out there that could do this stuff, because generally when I'd say now, if you're listening to Tony Robbins or, Sam Ovens or any of these kind of trade guys out there, they'd say like, if you want to kind of get to the good bit, just buy my course for $5,000 or, pay me $500 an hour or whatever. And I don't do that because I don't have to. I make enough money trading. I do it for the reasons I've just told you. And it's a unique business model. My time, my software and my webinars will be free, and I will never charge them because, like I say, if you want to learn, I'll invest some time with you. But, again, you've got to be serious about it. I'm not a charity. So I know I'm going to get my 8% win rate for my fibs, and this is really, why I've had 15 years of success, and it's what my go-to. They're my go-to. In the higher time frame, I'll go to that, and if I don't see it working, sometimes I'll just stay out. So sometimes if I can't make any heads or tails of the fibs and I can't make any use of them, I just won't trade. I just won't trade that market. I'll go and find something else. So I'm not interested about trying to force a market to fit into my rules because I know that only works 80% of the time. So I don't feel comfortable and I don't see the patterns. I just stay out. And if you're ever going to be good as a trader, sometimes sitting on your hands and not trading the markets can be just as profitable as staying in, because a lot of people get disheartened by bad trades. A lot of people, lose more than they should because they're taking that view, they're holding on to an opinion. And you can't do that in these markets. They're just too aggressive, okay? So as I say, I could use time frames in any chart and any market conditions and any market. So I don't know if their indicator gives me that kind of level of consistency. I would say it saved me hundreds of thousands of dollars over the years in trades that I haven't taken, and it's certainly made me a lot more than that. So again, the important parts is going to give you entry, exit, and stop points. Yeah, get in or get out. So it's a total trading piece of information for me. And if you get your head around the fibs, where to draw them to or from, as I said, the VIP stuff will probably show you a bit more clearly. This is just an overview. But if you get into that head, that 80% mindset, then it's going to help you greatly. Conclusion. Well, people fail using fibs because they don't have a consistent way of plotting them. I've shown you straight off the bat, you have to pick an absolute high, you have to pick an absolute low, yep, and the market cannot go above or below that while you're sticking to the 80% Fibonacci rules. Yep, you cannot. And it has to be a strong directional move, yeah, which I've shown you, a strong trend, or it has to be a breakout candle, an extended move, which again, I'll show you in the VIP webinars, right? 80% of the time, I'm telling you, a market will retrace that 50%. So all you have to do is be able to pick a high and a low, pick the self-fulfilling nature of that movement and put your fibs in. So again, the full services, I'm not going to bore you with, with this too much, but this is a progression. Everything's free. Okay, even down here, when you get my time, you get the mentoring, it's still free, but you've got to invest some money in yourself. So you've got to put 25,000 and above into a CMC account, and because I know then you're going to have the trading size, you have the trading mentality, and you're going to have the ammo to make money. Okay, I have plenty of six-figure traders making 20% returns. I'm not saying I'm going to be able to do it with you. I'm always honest about these things. I'm not saying I can even work with you because I am free. If I don't think you're going to listen to me and I don't think we're going to work, then I'll just say, hey, it ain't for me. There's plenty of people out there that want to do this. But obviously, my time's limited and I can only help people that want to be helped. So VIP webinars, just open yourself an account, stick $2.5 grand in. You don't have to trade. It just shows me you're serious. And I'll open up the kind of fibs. I'll open up the different, techniques I've used that will just get you on whet your appetite. Okay. And then become a tier 1 trader where you get some time with me. Yeah, you're going to get some one-to-one lessons, mentoring sessions, chats. They're informal. I'm not a teacher. I'm not telling you what's right or wrong. I'm getting into your head. When you've talked to as many traders, hedge fund managers, retail traders, professional traders, I just know how to do these things. So I can get to the root of your problems very quickly. Sometimes it's confidence. Sometimes it's the markets you look at. No session is ever the same. But if you want to find out, if you're going to be able to make it as a trader or not, then just stick $5 grand in the account. I don't care if you don't trade $1 of it. But if you show me you're serious, invest in yourself, I'll invest for you. So tier 1, tier 2, tier 3. Tier 2 and 3 is where I've made the most successful traders because they have the most realistic aims. Trading, it takes money to make money. You guys are pretty lucky because MiFID 2 and ESMA, a lot of retail traders can't trade on leverage anymore. They had 500-to-1 leverage, they're now down to 30 or 40-to-1 leverage. You guys can still enjoy 400-500-to-1 leverage, but that will come to an end. Yeah, the rules and regulations will apply to Australia, New Zealand, Singapore, and Hong Kong, this side of the world, in time. So time is running out for the smaller trader. So again, all about timing, being right at the right time. So Q&As, guys. I mean, I just see Andy woke up 3 a.m. for this webinar. Wow. Okay, no problem. I appreciate your commitment. That's really nice to hear. Well, let's make it worthwhile. Let's go through some markets. Let me just pick the right screen. Okay. Okay, so this is what I look at every day. this is my window to the world. So I look at the same 8 charts and have done for best part of 15 years. This is my snapshot of the world. So as I say, we've seen the pound see a bit of resurgence. So this is after Carney's speech in the Bank of England. So as I say, these are my fibs. Okay, where's the 50% here? Market breaks down. It's getting to all these green lines, which are Fibonacci's. So when it bounces, what's it looking for? Looking for that 50%. Hasn't made a new low, so that the fibs stay in. Green, green, green. Back to that 50%. Can't stay above the 50% or make new highs above the expansions. Comes back to the green lines. So broken through below it, and it's now being pushed up on the hourly chart below this 423.6 retracement. And was it nearly touched? Back to the 261.8. So I've got a framework already of what the market's going to do. So this is, again, Mark Carney's report was all about inflation. Inflation goes higher, then they're going to have to talk about putting interest rates up, more quickly. It's quite famously, the Bank of England were priced in 90%. We're going to see a rate hike probably next month, and then it flipped to 10% because of some short-term kind of data. And obviously the whole Brexit thing hanging over its head. But one thing is, not going to change is the pound is completely undervalued. So there are opportunities to buy it low. So just against the dollar here. So obviously whatever Carney said is leading to a rate hike is, more inevitable. So people dump the dollar, go into the pound, and the market's going up. So from a fundamental technical perspective, the fib was a good place to buy. And, again, if you've been involved here, could have made yourself 48 pips. Easy peasy. The euro's taking a bit of a bid. Again, weakness in the dollar will lead to strength in the euro, strength in the pound. An interesting correlation between the currencies as well. As the euro gets stronger, people dump the stocks. So here is the DAX. That's moved lower. Okay, so not quite the same aggressive movement as the pound's going up in the FTSE. But again, correlations, coefficients to look at. As the dollar comes down, gold goes up. As the dollar goes up, gold comes down. So I was going to do a monthly Fibonacci on gold. Again, I've already got it in play. So from the low here to the high here, market's not made a new high. So I'm looking for it to get back to the 50%, which kind of ties in with my view that gold really should be getting down to $1,000. So we break the 1,200 level. Okay, then 1,000 really for me is next, directional wise for long term in gold, and all the reasons for that. Again, there's no shortage of supply of gold really. The kind of countries that hold gold are Russia, China, India, not necessarily the allies of the US. There's talks of mining on the sea where there's $1 trillion worth of gold, and there's potential of mining in space where there's potentially $1 trillion of gold. So this whole idea that's a protection of wealth, yes, I guess so. In some respect, people hiding gold bars under the bed. But look at the kind of modern attitude. People are much more interested in Bitcoin or cryptocurrencies or different forms. You forget that the investing classes change, and once the kind of older generations start to die out, people just won't invest in gold because they won't see the same kind of affinity to it, so they won't be bothered about the kind of physicality of it. They won't be bothered about this inflation proofing, because let's face it, inflation's been a joke since quantitative easing. So for me, as you scale through to the weeklies, you can see that the Fibonacci is how they work. 23.6 broke through support, now maybe resistance. So you got the 38 and down to the 50%. So if you're going to do a longer term trade, you can put your stop here. So 800 pips or so to the 50%, 850. So a 1-to-1 trade. You can average into these points if you want to sell more here as it's going down. So again, that's how you start to build up trade ideas. Dailies, consolidation. I would expect this again to break down further. And you've got higher time frame points of attraction. These are just daily, weekly, monthly levels that have been drawn the same way as you draw Fibonacci, but based upon different criteria. And as you get down to the hourlies, again, market's moving up. Let it get to 23.6 and I'd sell it. Might be slightly for 10, 15, 20 pips down to these levels. But again, building up an idea of why you're trading for what reason. So again, dollar came down and bounced. That means if the dollar's going back up, which again, let's face it, it's going to have more rate hikes than the UK and US. So more dollar demand, gold becomes more expensive, gold you sell from the highs. So gold you sell from the highs, you buy the stocks from the low, because these are inversely correlated. Stocks goes up, gold goes down. So again, it's looking at these 8 charts and figuring it out. And then you can build your own ideas of what else could be interesting. I've told you I've been a six-figure buyer of the pound against the dollar, and I've been some time. So, nasty day yesterday. But look, the fibs, where's it stopped? The 61.8. So I'll be buying it back to here, back to the 50%. I think it's going to get back above 2. So, okay, we had a bit of a natural bounce off the sell from the Kiwi. But let's face it, Kiwis are exporters. They want, a better exchange rate. They're not necessarily looking to put interest rates up anytime soon. Interest rates aren't going to help borrowers, and they're certainly not going to help people, buying overinflated house prices. So, it's looking at that slightly longer term, medium term view to get an idea where the trades could be. But as I say, that's really the only longer term trade I've had in a long time. The majority of trades are just back, to the to the hourly charts and just trying to figure out. And once you've got a trade, say let's take gold for instance, you break it down to the time frames. Okay, so then you've got your daily, you've got your hourly, your 15-minute and 5-minute. You start to sharpen it up with your oscillators. 5 minutes, break above, Fibonacci expansion, short squeeze, back to the weekly, get short, 50% comes down. What do your indicators tell you? Time to sell. Marry them up. You've got levels of attraction, for the fibs, and with your points of resistance. The market comes down. You don't have to be aggressive and be in before it turns, to an absolute sell. But you see the rejection, the market then goes up, sell at 50%. There you go. You made yourself, 12 pips, 13 pips, not to be sniffed at. Again, your 50% fib come into play. That's the 5-minute. Again, you've got the same on the 15-minute chart, your hourly. So all these charts are marrying up and giving you that accurate kind of view of what the market's trying to achieve. So again, on your hourly charts, you see the market's massively oversold. So you don't necessarily have a line to sell, but you've got an indicator saying, hey, there could be a potential sell here. Then 1, 2, 3, 4, 5, 6 hours of selling. So you just have to be involved, get involved in that selling. So I mean, that's a bit of a roundup. Is anything else anyone would like to ask? I mean, again, the Fibonacci, the more educational part, that's giving you an idea of something you can take away and read more about, or read different people's opinions about, see if you can get to that 80% kind of success rate and just charting it yourself. Then the next step is to put it into a trade, put it into the markets. And as I go through the weeks, as I go through the different styles of technical analysis and certainly fundamental analysis that we can use, you start to build a bit bigger picture how you can plug yourself into the markets. Then the next step is to trade some live money, or if you've already traded before with whatever results, come to me and we can do some mentoring, and I can make a good trader great, a great trader exceptional. As I say, it's not always 100% success rate for everybody, but that's just life. I'd be lying if I said that I made everybody better. It's like going to a golf pro. Some people, only get average. Some people only become okay, but okay can be still good in the markets if you, if you follow the right kind of rules. All right, guys. Anything else? Okay, sorry, Andy's just come through another question. Hey, Steve, I see that sometimes you don't take the fib from the most high or low. Why is that? Yeah, good point. It's the most relevant move, and this is why I said traders, get confused. I look for when the move really started. So, I mean, again, it's different on different products. So for this, for instance, I don't see, this is the move that I'm looking for. Okay, so this high to this high. So you could say from a purist that your Fibonacci really should start from here to here. But I just don't see it that way. What I see is, again, just from years and years of charting, is the market's sold off, right? I get that. It's broken this trend line here and gone down. But this is the overexpansion. So the overexpansion here, I really think, is where the Fibonacci is really of most use, from this low to this high. And that's my 50% pivot. So 8% of the time, strong directional move, yada, yada, yada. Goes back to the 50%, doesn't make a new high, back to the 50%, doesn't make a new low, back to the 50%, doesn't make a new low, back to the 50%. And look at that, look how that acts as an absolute magnet, all that green around it, then support, and then it goes on to make a new high. So this fib, I guess, is dead, but it shows you that it didn't want to make a new low. It want to get back to this trend line here, and this is the self-filling nature. So it broke it here, but it also acts as a point of attraction in the future. So you got double confirmation, yeah? This is why, again, it's just experience. This is why this fib on the shorter term for me, came into play. Market consolidates, doesn't make a new low, test that 50% a few times, finds ultimate support, finds support on the 61.8, goes on to and breaks higher. So you'd expect it to get to the 61.8 expansion point. So, you know, that's your fibs, you know, what's happened in the past, working in the future. So again, this is where you get the confidence yourself. You've got to see what is the most relevant to the time frame you're looking at, what's most relevant to the trade you want to do. So, you know, you don't always have to take it from the extremes going back in time. You can pick and choose what works for your trading. And this is what is difficult. And this is why, again, when you look at my charts, the way they are, and you see the green and red Fibonacci's, they are the 50% pivots in white, which you can see the market's attracted to all the time. But the green are retracements and the red are expansion. They're automatically drawn. Okay, so they're drawn in from different criteria. So I know that I don't have. If I want to draw my own fibs, that's on my own intuition. But my own, you know, proprietary system will put the fibs in for me, because that's just taking data and movement. So it takes the emotion out of it. It takes the thinking about it. So another way of looking at the charts is by doing it like that. So. Good question, Andy. Very good question. You're right to point that out. And as I say, it's really all about figuring out what piece of movement is relevant to what you're looking at. So if you go too far back in the charts, you're going to get too much, you know, fundamental information, too much movement. And if you don't go far enough, then you're going to get too much noise. That's why I always kind of say, build up your bigger picture. Monthly, weekly, daily, look at the hourly, and then for your entry point, 15-minute or 5. As I showed you in 4 screens before, then you can get the right kind of entry based upon all the kind of technical data that you're looking at. All right, guys. Anything else? Anything final you'd like to ask? I mean, again, we'll go through probably next week some fundamentals, so you can get abreast of the idea of, you know, what you should be looking at for speakers, how to deal with Trump and his tweets, how to deal with this idea of fundamental sentiment, I guess, you know, the inflationary pressures versus growth pressures, trade wars like, you know, China and the US, and just generally the political landscape changing. You know, Italy's been a big one in Europe, and with the populist government getting in, a lot of problems to come out of Europe yet. It's not a win for Brexit for Europe every time the UK loses. So there'll be big shifts in the currency and probably a big shift in the stock markets too. All right, guys. Well, as I say, help me spread the good word. If you like what you've heard, you know, if you've got any friends who are interested in trading, send them an email, tell them to come to the site, sign up for a free webinar. You know, again, it saves me a lot of money advertising, so I'm not going to shame to ask. You know, the more people in these webinars, the better questions you get and the better experience you get. In my webinars in England, I have hundreds and hundreds of people attend them, and built up a big following, and I still do that. I'm still the chief market strategist of Intertrader in London. So really, you know, again, I'm trying to build up a base over this side of the world. It's been a couple of weeks, so, you know, we're very new into this, but I'll continue every Tuesday at this time with the new webinars. And as I say, for the more advanced stuff, you know, just join the VIP webinars, or you want the one-to-one stuff, just as simple, you know, just open an account with CMC and put some money in there. As I say, I don't require you to trade it, but, you know, you will benefit from having that money in the account and, you know, having that reality, you know, that kind of psychological side. You start to deal with these things a lot better. All right, guys, well, listen, I'll leave you to it. Any question you've got, email steve@steveruffley.com. Follow me on Twitter. That's where I'm most active, at Steve Ruffley. Facebook page, Steve Ruffley Mentor. Not a difficult one to find, so just Google me. All right, guys. Well, you're going to get a recording reminder after this, and I'll put it on YouTube. So feel free to look it up there. And in the meantime, you know how to get hold of me. All right, guys. Have a good night. Speak to you all soon. Thank you.